Hello, everybody. It's April 6th and it's 11 a.m. And we've got some special guests here. You may be wondering why Max and Bailey finally showed up. They've been no-shows for a few of our webinars, and the answer is treats. Treats work very well. We'll see how long they stay because can't just keep feeding them treats. They won't eat anything for dinner. But they're going to probably be paying attention. Usually Max is dead asleep. Also, somewhere around here is another one of our little dogs, Cooper. So we'll see if she makes an appearance. And then we have a fourth one, Chloe. Chloe just hides out in my wife's closet upstairs. She's shy. Anyways, nothing to get shy about in the markets these days. Well, we'll see. Clearly, we've had a pullback in the S&P 500. It hasn't really been a outright correction, down about 9% from the January 27th record high. As it turns out, when you look at the forward PE of the S&P 500, it peaked back last year on October 27th. So if you kind of define a correction in valuation terms, we've had a pretty significant valuation correction since October 27th, right around when Michael Burry started raising some concerns about the profitability of all the AI spending. And sure enough, it was a good call, but it kind of also was a call that because of his credibility, it certainly had an impact on driving down the multiples of particularly the Magnificent Seven. It was on December 7th that we concluded that there might be a pullback here, maybe even a correction. But the pullback idea was based on the notion that the market had lost its confidence in the AI trade. And as a result of that, we might see some weakness in the Magnificent Seven. As a matter of fact, we recommended underweighting the Magnificent Seven on December 7th. A couple of weeks ago, I think it was 2 weeks ago, we recommended market weighting them because the valuation multiple had come down quite a bit. So that's where we are now with that kind of recommendation. With regards to information technology, we on December 7th lowered information technology and communication services from overweight to market weight. Maybe we should have done underweight, but information technology and communication services can move very quickly to the downside and to the upside. And so we figured that was a reasonable thing to say, especially since the two of them accounted for 46% of the market cap of the S&P 500. Kind of found it hard to continue to say overweight the sectors that already were quite overweight in the market cap. However, the earnings share has also been very impressive, and we'll look at some charts on that in a minute. We did last week on Monday. I think it was on Tuesday or maybe Monday night. We did call a bottom in the S&P 500 on Monday of last week. It was quite a significant sell-off that day, and then Tuesday and Wednesday, the president started to suggest that there might be an exit ramp finally. And sure enough, Wednesday night, he gave a speech in which he said that this war should last another 2 to 3 weeks. Now, of course, I've said before, and I'll say it again, I reserve the right to change my mind as often as the president changes his mind. It's been a wild ride here trying to stay on top of the situation. I mean, the fog of war is usually pretty thick, but with Trump, it gets even thicker because you never know what he's going to say next. One of my accounts emailed me if I knew if Trump was going to say anything today, and I said he talks all the time, 24/7, so he's bound to say something today. I know right before I got on, I noticed that there was I got a notification that on X, the foreign minister of Iran said something. I was wondering whether that might give any indication that Iran was backing off. Quite the opposite. He basically said what Iran's been saying, tit for tat, whatever you do to us, we'll do to you. So that sounds pretty belligerent. Doesn't sound like there's any give. The president's been kind of like a two-handed economist, this and that. On the one hand, he's been talking about obliteration day. He didn't use the word obliteration day. That's our construct. He called it, I think, power plant day and bridge day. And I guess that's coming Tuesday night at 8 p.m., subject to his changing his mind. I guess if negotiations, and apparently there are negotiations, but if that's the case and they're going well, he might postpone it again. But he's using expletives now in his social posts, so he's serious for sure. And maybe this time around, if Iran doesn't make some important concessions, maybe there will start to be some serious obliteration of electric power plants by the U.S. Over Iran. But nevertheless, the history of some of our most recent wars, American wars, has been that sometime, when they start, since the beginning of the first day that the war starts, 2 years later, if you got some patience, the markets typically do better. So we're looking for our call basically is the PEs come down a lot, anticipating that this war could last longer, be more serious, maybe even cause a recession. On the other hand, the earnings story remains remarkably solid. There was kind of a flattening out last week, as we'll look at some charts again. But the PE's down a lot, but earnings are up a lot. If it hadn't been for that, we would have had just an outright correction and almost a bear market since October 27th. The PE is down about what's down about almost 18%, but the E is up about 12%. So the overall market is down by basically 6% from the October 27th PE high. Numbers don't change radically when you start the clock on January 27th. And then I guess the war itself started February 28th. But all in all, the conclusion is wars are buying opportunities historically. Maybe this one's different. Maybe this one will be, insanely. Maybe this will be World War III. Some people are talking about it. Neil Ferguson, a historian I respect, first started out being all for the war, and then along the way, he's concluded that this could get out of hand, out of control. And I think he's still for it, but he's now talking about a recession. And so we'll see. There isn't too much recession talk yet among economists, but at least Neil Ferguson on the historian side is, I guess he gets the prize for being the first one to say this is going to lead to a recession. Well, let's share some charts here. Let's look at what's going on here. So again, the call on Monday was based on the notion that we did have a pretty significant sell-off. It's based on the notion that the valuation multiple has come down quite a bit, based on the notion that the president at least seems to want to exit in the next 2 to 3 weeks, one way or another. It's based on the idea that one way or the other, not all the oil, but quite a bit of oil will get out of the Strait of Hormuz. Again, we don't really get much out of the Strait of Hormuz. It's really China and India and Asia generally, Korea and Japan. And the president said, leave it up to them to figure out how to get that oil. The Iranians are going to want to sell it. So they're going to let oil from vessels that don't have American and Israeli flags on them, or somehow registered as U.S. or Israeli. They're going to let oil through, and the Saudis are going to continue to pump through pipelines. And so far, the price of oil is kind of hanging in there around 100, 110. Obviously, if it jumps up to 120, 150, which some Wall Street analysts have warned could happen, a few even talking about 200, that's not the calamity I think is most likely to happen. But I'm not going to tell you it couldn't happen. It certainly could. What else do we know? Oh, we know that the sentiment has been very bearish. The bull bear ratio didn't get down to one, but got pretty close. It got down to 1.1. So the bearishness is pretty thick out there. And then of course the earnings story is kind of holding up remarkably well, and it's not energy, believe it or not. So to prove it to you, let's, as I said, let's go to some charts, and we'll start out with the quick takes. So here's that chart on the 2 year performance from the start, the day that these wars started. So you can see in this legend box the Korean War, Iraq, Gulf War, World War II. Coming out of them, the market 2 years later was up substantially. Not so much Bay of Pigs, but I don't know that that really counts as much of anything. Vietnam obviously counts a lot, but that was a very, very long war, and it certainly triggered inflation, tightening of monetary policy. It kind of led to the disastrous 1970s, disastrous for the economy, 1970s of stagflation, and that was a dead decade for the stock market. So stagflation, the 1970s, all over again. Those are the risk scenarios. We've written about them and talked about them, but we're still base case 60% roaring 2020s. Speaking of roaring, earnings are absolutely roaring. And it looks like maybe, just maybe, the analysts have finally gotten the memo that there's a war out there in the Middle East and that it could cause a recession or could have an adverse impact on the U.S. Economy. And you can see that after substantially increasing their earnings expectations for 2027 and 2026, we have this latest week where it's kind of flat. I mean, that could just be because we're getting really close to earnings season. And usually when you get close to earnings season, analysts have a tendency to actually lower their earnings expectations. Actually seeing them raising until this latest week is really quite impressive. And meanwhile, forward earnings, which we've told you before, we think is one of our favorite economic indicators. It's really good at telling you what the economy is doing, with one important exception. It doesn't see recessions coming. So if you agree with us that the economy is resilient and it's going to pass this latest stress test again, then I guess the conclusion is the forward earnings story might be relevant here. The economy might continue to be resilient, and so will earnings. This is another look at earnings on a quarterly basis. It's analyst expectations on a weekly basis for Q1, 2, 3, 4 of this year. And again, you can see that this is quite unusual. Usually going into an earnings season, and we're in the earnings season, just starting it. We had Nick Rayshon last week, and he talked about the 16 companies that have already reported, and based on them as a leading indicator, the earnings season is likely to be quite strong. And he's done a lot of work on that. I got a lot of good positive feedback on having Nick on, and we'll keep that going as a tradition, probably before earnings reporting seasons, maybe more frequently if you like. But as you can see, the first quarter's held in remarkably well, and that's very unusual. Usually they cut it. And then we get an earnings hook. It'll be amazing if we get an earnings hook when the analysts haven't really gotten all that negative, but it's conceivable. Meanwhile, look at what they've done with the estimates for the rest of the year. They've been going up until this latest week. And then when you look at forward earnings for the S&P 500, the S&P 400, 600, this is a healthy development, right? This is kind of the breadth of earnings. Not only are earnings very strong for the S&P 500 in terms of forward earnings, analysts consensus expectations, the time-weighted average of this year or next year. This has started to go up into record highs. This hasn't broken out to record high yet, but at least it's turning higher. Maybe the war will upend everything, including my relatively optimistic forecast in the roaring 2020s. But for now, I'm sticking with it. Um, it's my story, and I'm sticking with it, as they say in the movies. So here we go. Forward earnings per share. I get a lot of questions about, well, what is driving forward earnings? Well, if it's energy, that's not something that we necessarily can get excited about unless we own a lot of energy stocks. But a lot of the energy stocks performance has been PE. The earnings story hasn't been all that exciting. This is energy is 47.2. So that's this red one you see, or whatever color it is, chartreuse or purple. But you can see that we're still on a downtrend, but just the past week or two, this thing has kicked up a little bit. Meanwhile, technology is going to the moon. This is healthcare is kind of flattish. Then we've got consumer discretionary, not too shabby. Financials is in here, and again, that's also I think it's at a record high. So it's a pretty the breadth is pretty good for the forward earnings within the S&P 500. And then we show you a chart that says, well, the reason that earnings may be holding up is not only is the economy holding up, so revenues are holding up, and maybe the global economy must be holding up too, surprisingly well. Again, all that I guess could change if this war gets uglier, escalates, and it turns out to be a forever war of, exchanging missiles. But then again, if it's if we're out of there in 2 to 3 weeks, and everybody else figures out how to get the oil out of the Persian Gulf, then maybe this will continue to be the Roaring Twenties will be back intact. But the Roaring Twenties have been all about productivity. Productivity boosts real GDP. Productivity dampens inflation, which will be kind of important given we're going to have an oil shock here in the next few months, at least. Maybe not. Maybe it will be fairly short. I don't want to use the word transitory because that's jinxed. But the Roaring 2020s productivity story shows up in profit margins, and if you read the quick takes and look at the chart, you can see it's a pretty compelling case that a lot of sectors are continuing to see their at least forward margins go to record highs. And forward margins tend to be pretty decent coincident indicators of the actual quarterly numbers. So we take them seriously, and they're available weekly, which is, I need content. So the more data I have on a weekly basis, the more I can espouse about these things. Here's the Magnificent Seven. Some people have started to call them the Not So Magnificent Seven. I'm going to stick with the Magnificent Seven. Um, their earnings, the forward earnings remains very significant, all-time record high. And oh, by the way, the 493, I call them the impressive 493. They're actually showing some a pickup here, also at an all-time record high. So here's the PE, and if you go to the October 27th low and take the drop here was 17.8%, about 18%. I'm sorry, that's the Magnificent Seven. The S&P is about a 17% drop from this high. Again, right around December or so, when the PE of the Magnificent Seven were around 29.30, we said let's underweight them. Things can move pretty quickly here, and around 25, we said, well, maybe that's good enough. It got down a little lower than that, and clearly the next couple of days will be make or break for the idea that Monday was the bottom. I hope you'll forgive me if I'm wrong, but I at least want to think along those lines and what could go right. You can stare at this on your own. And this another interesting thing is the technology forward PE. Look at this back here. You had the forward PE, the S&P 500 get up to about 25. The technology PE went up to over 50. Uh, did that. Then it took a dive for a long time, and then it's been rebuilding ever since. But in line with the S&P 500, um, and then it's been out of line high, but it's not. It doesn't look like this. Kind of looks like a mini version, but now we're back to technology being relatively cheap. I guess the growth story is still there. It's just there's a lot of uncertainty about who's actually going to get all the AI goodies and SpaceX, exploring space goodies and all that other stuff. Here's another similar chart that shows the market cap share of telecommunications, communication services, and information technology, and it got to a little over 40% market cap share. And look at the earnings share. It was down here. It was a 15 percentage point spread. This time around, the spread is right now 1.6 percentage points. So the earnings share has actually gone up, and and a lot of that is the Magnificent Seven. And there's a reason for the concentration that we've had. But on the other hand, I think we are seeing forward earnings broaden out and the market broaden out. Now let's see if I can segue to the morning briefing. Yeah, tell me if you can see the chart collection for morning briefing. Just one or two of you, just give it to me in the Q&A if this is showing up. Yes, wonderful. Thank you. Okay, I don't need any more. So this is let me open that up a little bit. This is the chart collection for April 7th. The Ardeni Research decided to take Sunday off, so we didn't write on Sunday. It was Easter. Everybody wanted to enjoy the holiday with their families. The morning briefing is for tomorrow. It'll actually be released this afternoon in an advance copy. But it was all about, it was called The Anatomy of the U.S. labor market. It's all about the latest employment numbers. And as you know, a lot of economists, everybody kind of tunes into CNBC, tunes into Rick Santelli telling us what the details are about the employment report. And then there's kind of a knee-jerk reaction that it's a good report or a mixed report or a bad report. And I think this time around, the widespread consensus was that it's a good report. And we'd like to come to the same conclusion, but we can't because when we look at the employment report, we look at payroll employment and its revisions, but we also look at the average work week, and we also look at wages. In other words, what matters to us is how it all adds up for wages and salaries and personal income, because that's purchasing power, and purchasing power drives the consumer. And sad to say that the our earned income proxy for wages and salaries was up. It was up at a record high, but it was up only 0.1% in March. The problem with that is we know that we're going to have a big increase in the CPI and the PCED inflation rates in March at maybe zero point 0.6 to 0.8. So real wages, the real wages and salaries component of personal income, personal disposable income is actually weak, and real disposable income has been kind of flattish for the past several months. And some pessimists have been pointing that out. I'm sure more will be doing so, but we've been arguing that a lot of that has to do with the aging and retirement of my friends, the baby boomers. A lot of the baby boomers have had long, successful careers. They've been making a lot of money, and then boom, suddenly they're out of it. I'm getting emails from friends saying that they're retiring. I wish them well and all that. Enjoy the next stage in your life and all that. And they're having a ball, but they're spending their net worth, and we've just discussed this before, that they're sitting on $85 trillion of net worth, and they're spending it. They're helping their young adult kids, and they're helping their grandchildren. with the affordability problem, which to a large extent is a demographic one. Young people are facing a lot of issues with the affordability. Older folks are, to a large extent, are retiring. They have an affordability issue if they haven't accumulated a lot of net worth, or they're not don't have much in the way of dividend and interest income. But I would argue that a lot of the baby boomers are pretty comfortable. I mean, somebody owns $85 trillion, and sure, there's wealth inequality, but a lot of that wealth is in real estate, is in housing, it's in the stock market, it's in pension plans, 401ks, and so on. Even though real disposable income is flat, we're predicting that consumer spending will continue to grow, and that the disposable income adjusted for inflation will be flattish, and that the savings rate will go down. And none of those things are anything to get all agitated about, but just as demographically, it is what it is. It's natural, and it's not a disaster for the economy. And the retiring of the baby boomers, I think, has been a much bigger influence on the shortage of labor, um, and and is a much bigger influence on forcing companies to increase their productivity. So here's the total work hours showing payroll employment times the work week, and it's kind of flattish. I mean, it's still got a bit of an upward trend. This is average hourly earnings adjusted for inflation. Is this one? Average hourly earnings was up only 0.2. I think this was down 0.1. So despite that big increase in payroll employment, we were actually down zero point 0.1 in uh, total hours worked. And that was offset by an only 0.2% increase in wages. So our earned income proxy increased by zero point 0.1. Here's the average work week. It's kind of volatile week to week. I guess the next thing it's going to do in April is go up like that. It's just kind of swings around. Kind of an odd variable, but you got to, that's the way things add up to wages and salaries. This is a very strong payroll report. I think the weather had a lot of impact on December, January, and February. December was bad, January and February were bad, and that kind of depressed some of the activity in the economy. Um, including the labor market. So here you have the earned income proxy up as just zero point 0.1. These are the other components. And here's Oh, this is wages and salaries. See, it correlates very well with wages and salaries in personal income, and that's one of the bigger components in disposable income. And disposable income, you can see, has kind of gone flat here, and you can get all hysterical about it and say, how can the economy grow if disposable income is not growing? And the answer is net worth. Retail sales, we watch it weekly. It's pretty good in terms of getting the extremes. Not perfect, but it's right now suggests that consumers are still spending. Baby boomers are retiring. They're retiring with a nest egg of drumroll, $89.6 trillion dollars. I guess I've been talking about Q3 numbers. The uh, the Q4 is up to $89.6 trillion dollars. The savings rate, I think, is going to go down still further. And we've kind of run out of time, so I'll let you read the rest of the morning briefing later this afternoon or tomorrow morning. If you don't have any questions, I guess I must have been amazingly thorough. If anybody has a question, feel free to uh, send it now. We'll wait a minute or two, but then we will be over what I always try to keep it to half an hour, but I'm always longer than that. I see that the puppies abandoned me, so I guess they weren't too interested in what I have to say. Well, no questions. I think I covered quite a bit, and I hope that was somewhat useful. I acknowledge that the next couple of days could be make or break. Oh, Sal, hi Ed. Can you discuss the impact on oil prices on the U.S. economy? Yeah, we've written quite a bit on it. When the war first broke out, we showed that the energy efficiency of the U.S. had increased rather dramatically. We use less oil and gas to produce GDP. Pointed out that as a percentage of disposable income, gasoline is decreased rather significantly. It still obviously has a impact on inflationary expectations and so forth. Um, and then pointed out, as we all know, that the U.S. it's not like the 1970s where the U.S. really depended on Middle Eastern oil. Now we are independent, so we produce enough to export oil and gas. Adam, oh, they're coming now. Okay. Hi, Ed. Curious if you have any thoughts on the proposed budget Trump put out over the weekend, including the 1.5 trillion in defense spending. Well, the world is becoming a more dangerous. I guess depending on what part of the partisan divide you're on, some would attribute it to Trump's policies, and others would say that Trump's policies are a response to the fact that the world's become a more dangerous place. But as you know, we try to be objective about these things and focus on what the market cares about. We've often said that if you let you shouldn't let partisan politics get in the way of investing. So that's kind of a principle by which I have my own political views, and I've confessed to you before that I'm a Madisonian constitutionalist. We could talk about that another time. But all in all, I think that it'll be interesting to see how that all adds up in terms of deficit projections. Going from 1 trillion to 1.5 trillion obviously means the deficit's going to be half a trillion dollar larger unless something happens. And I don't know, I don't think that includes the $200 billion request to fund this war. And then again, maybe Trump will get some of the Middle Eastern allies to help fund this war. But we'll see. But it's not promising for the deficit outlook. And then the question is, what will the bond vigilantes do about it? And right now, the bond vigilantes have been remarkably calm. It's been a sight to behold, really. Inflation is going to be higher for the next several months. The deficit outlook is deteriorating as the war costs increase and as the pressure to increase defense spending are on. Um, the administration has been talking about cutting non-discretionary spending by 10%. Well, good luck with that. So I'm sure we'll have plenty of opportunities to opine on whether the bond vigilantes care or whether they're back or not. Gary, what do you see happening if Trump actually follows through bombing Iran infrastructure as stated? I guess his threat to put him back in the dark ages will obviously be fulfilled when the lights go out. The problem, and I kind of early when the war first broke out, I said it should be short, given that the Iranian leadership was taken out. And then 3 days later, I had second thoughts about that. I remembered that the problem is that as the Revolutionary Guards are basically professional terrorists, and it wasn't going to be very easy to sit down and negotiate a deal with them. And as long as they have missiles and drones, the Iran may very well continue to be trouble. But then again, there could also be a significant civil war within Iran to the extent that the populace, without lights, without food, without rise up against the Revolutionary Guard. Who knows? I have to really stop opining on how this war goes because I don't know much more than anybody else does, and that includes the military strategists that have been running this thing. Um, okay, John, if the war drags on for a few more months, with oil getting through the strait as now, will the equity market more increase? Uh, yeah, I guess the basic question is if this is it, if the war continues, maybe the U.S. isn't there, but Israel and Iran keep at it, and Iran keeps shooting at Saudi Arabia and Oman. Well, not Oman. I think they're trying to get a deal to manage the strait. Um, as long as the price of oil stays around $100, I guess that would be the indication of that. The price of oil clearly reflects more of a risk premium than an actual shortage at this point. But I think that the market could probably live with $100 for a while longer, whereas 125 to 150 with people talking 200 would mean that my call for a Monday bottom is just dead wrong. Uh, Good morning, Dr. Ed. Love the updated functionality and look of the site. Yeah, we just redid the website. It's a lot more, uses a lot more artificial intelligence. Uh, Still a little reorganization that needs to do. The charts aren't exactly in the same places that they'd been before, but for all intents and purposes, it's the same website, just spiffier and with more functionality. So glad you like it. Okay, fertilizer has gotten very expensive and difficult to get. Impact on the American farmer and inflation. Yeah, there's a lot of commodities coming out of the Persian Gulf that have become hard to obtain, and some of them are for fertilizer. And so more expensive fertilizer going into the spring season is probably going to mean more expensive crops if they don't use the fertilizer as much. But again, I'm talking about a subject. I shouldn't talk about military matters or farming matters, two subjects that I'm not particularly familiar with. We have, let me see, Francis. Haven't heard from Francis in a while. Hi, Ed. Boomers reducing personal savings rate by spending net worth. Trump wants to boost defense spending, and oil prices yet to hit inflation data. Sounds bound bearish, which everyone seems to be. Yeah, I mean everybody. I mean, I've been thinking 4.25 to 4.75% would be kind of the range, and if we get back up to 5%, everybody would be buying the bonds again at 5%. But yeah, all the data looks like it should be bearish for the bonds, except for maybe the bonds are anticipating that this will all lead to a recession, in which case they're figuring somehow or other if well, I guess the bonds could Volcker us. The if the Fed's not going to go Volcker, maybe the bonds will go Volcker. But right now they're not. So how do you square that? And I can't, other than to conclude that government bonds are viewed as a safe haven. Take one last one from Lee. It would seem that the top 1% of net worth of people over 70 is approximately $17.5 million. Maybe you meant people. However, only about half is in equities and bonds, while the rest being in private equity, lending, and real estate. With so much wealth tied up in illiquid assets, does this raise a potential problem for spending and the wealth effect, which is driving? I don't know. I'll look into that. It's a good point, Lee. But money market funds uh, are at $7 trillion right now. I think retail is about $3.5 trillion of that. There's a lot of liquid net worth out there, and people wouldn't be retiring just anticipating just on illiquid net worth. And obviously, with what's going on with private credit, they're going to be rebalancing to the extent they can. They're not going to be putting more money into private credit. Well, I overstayed my welcome as I always do, but I try to get to some of the questions. I should keep my comments shorter. I'm working on it. Anyways, I'm working on my forecast as well. It's been a heck of a wild ride trying to do the best I can for you. And let me know what you're thinking. Set me straight every now and then. And have a good week. It promises to be another one of those kind of wild wartime weeks. Good luck.